Hi, this is Ben Taylor of Brick Financial Management for the thirdpig.com blog. Just wanted to do this really quick video today because of the things that are going on in the market. Haven't done a video in a while, but hopefully that'll change. I'll be putting out videos more often. Friday, Standard & Poor's downgraded from a AAA to a AA the rating of the U.S. debt. That had consequences in the market, and that the market kind of reacted to it negatively. Although I think the debt was downgraded for more political reasons, and if you read Monday's entry on the Third Pig, you'll kind of see that. That's really beside the point. It's really how you should react to it. The market from Friday, and we'll say the market is the Dow Jones Industrial Average, from Friday to Monday dropped 634 points. Okay, now that seems like a big number. If you read any of the headlines, it's like the sky is falling. It seems like they want you to panic, and I'm going to say don't. Okay, 634 points is significant until you look at it on a percentage basis. And on the blog, you'll see a link to the top 20 down days on a percentage basis. Now, from Friday to Monday, it didn't even register. On a percentage basis, the Dow Jones was down 5.5%. Okay, although that is, large on a day-to-day basis, in the grand scheme of things, it really isn't. And if you stuck around to the next day, the Dow Jones actually gained most of those points back. Today we're up and down. But that's just the nature of the market. You're going to be up and down. All right. The best thing you can do is see how those changes day to day affect your personal portfolio. If you looked at your portfolio, you may have been down, but your asset allocation should determine whether you should be concerned or not. Okay. If you're long term, you should be in stocks, and long term means years, not days. So what happened yesterday should not affect you. Okay. If you're in stocks, you should be looking at 3 to 5 years at least, and most of the times longer. If you're in your 40s or your 50s, chances are you're a little far off from retirement. You're not going to need that money right away. So what does it matter if the stock market is up or down? In the meantime, though, what it does for you is gives you an opportunity to maybe buy into some stocks that may be a bargain that day. And I'll give you, for instance, in our own portfolio, we hold eBay. eBay from Friday to Monday, in sympathy with the general market, eBay declined about 8%. Okay. Now, does that mean eBay is all of a sudden not a great company? Does it mean you should sell? Likely not. I mean, unlike the government, eBay has a lot of cash. eBay has over $4 billion in cash. Okay. And it only has about 1.5 billion in debt. So they can pay off their debt anytime they want. What it did was allow you the opportunity to buy into eBay a little more. If you're in a mutual fund and you're invested in the general market, maybe you want to buy in a little more. Bottom line is, over time, the stock market will go up and down. Points don't really matter. Percentages does, but it goes up and down in an upward trajectory. I made this little chart on a whiteboard just because I wanted to use my whiteboard. And if you see, it's just a simple thing. Okay. If you're putting your money in stocks, the stocks will go up and down over a period of time. Okay. But it goes up over a long period of time. Up and down in the short term, but over the long trend, it's going to be up. If you put your money in cash, okay, cash is not the greatest investment. And this is, if you look at any chart, any historical chart, okay, your cash will have no volatility in it, except it will go downward, especially when you add in inflation. All right. So don't cash out of your stocks. Don't go around selling your stocks just because, some ill-advised advice from your financial advisor said, stocks are going crazy, put your money in cash. I heard that on from someone yesterday that their financial advisor told them to do that. That's just bad advice, okay? If you're long term, stay in stocks, right? Matter of fact, keep buying in, especially when you're down. If you're short term, that's when you should be in cash, all right? And like I said, we use eBay. You'll see a couple of charts on the blog that lead you to some information about eBay. eBay, as an example, down 8%, okay? Had you bought in, you would have done great because the next day it was up 11%. Today, maybe a little bit more volatile again, okay? But just keep plugging away. Don't be discouraged by the financial headlines that say the sky is falling, all right? Once again, this is Ben Taylor for the thirdpig.com blog. See ya.